Hello, everybody, and welcome. This is Travis Watts, Director of Investor Relations at Ashcroft Capital, and today we're discussing what is a cap rate or capitalization rate. So simply put, cap rates are just a common gauge or a metric that a lot of investors look at to determine the value and the income on a commercial real estate property. They can also give a little bit of insight into how hot the market is, how competitive the market is, I should say. For example, a very low cap rate like 3%, as an example, may indicate a very competitive market where there's a lot of bids for properties, as compared to a 7 cap rate, which may be a property in a less competitive market space. So said another way, a cap rate could be a number that helps investors convert a property's income into value. So let's take a look at that. If you take the income on a property divided by the cost or the value, that's what gives you the cap rate. So keep in mind that this is one way, but certainly not the only way of measuring a rate of return when it comes to an income generating commercial property. And when I mention taking the income divided by the value or the cost, we're talking about specifically the net operating income divided by the market value or cost. That's what gives you the cap rate. Something else that's quite useful when it comes to cap rates is if you know the cap rate in your particular market, then you can find out what the value is of a property approximately. So the formula for that would be to take the net operating income divided by the cap rate in that market equals the value or the cost of the property. And I want to take a minute to define net operating income. Simply the gross income that the property produces minus any expenses. And when I talk about expenses, what I'm referring to are property taxes, insurance, utilities, maintenance, property management, and so on. One thing that's not included in the net operating income are any financing costs. So whether a buyer or a seller has a mortgage, that is not going to play a factor in determining net operating income. So generally speaking, the lower the cap rate, the higher the purchase price of the property. That's just a general rule of thumb. And of course, the opposite of a high cap rate indicates a lower purchase price. Something else to keep in mind is that a cap rate only tells you a portion of the story. For example, you might be looking at two different properties. One is in the middle of a big city center hub. It's got a 3% cap rate. The other is on the outskirts of town with a 7% cap rate. And on paper, you might just assume that a 7 cap rate is a better investment, when in fact, it may have a higher cap rate because it's having trouble getting rented out, or it has a lot of deferred maintenance. It's not in a desirable location or neighborhood. Or there may be inaccurate accounting numbers leading you to believe it's a 7 cap rate when in reality it's not when you dig through the actual financials. There could be a multitude of factors. So the point is there's still more research and due diligence to be done when analyzing a property's value. I hope you found this short video segment to be helpful. As always, if you have any additional questions, I'd be happy to have a more in-depth conversation with you. You can always reach out to me, Travis at ashcroftcapital.com. Thanks for watching.